The short term, in terms of profit impact, there's a write back of about $65 million, which will go into the statutory accounts. It's an abnormal below the line item, so it doesn't impact the underlying profit. And then, give or take a splash, there's around $40 million of cash that will come back to the company, which is a combination of tax already paid, interest accrued on those payments, and some of our costs, which we aim to be in a recovery mode for as well.
So where do you throw that? Do you throw that at debt, or do you throw it at some projects?
Yeah, no, so there's under our banking covenants, all of the proceeds from both asset divestment and for things like that, there's a regime embedded in the syndicated finance agreement. We're looking to do something a bit different with the banks in terms of repositioning ourselves. So we'll probably put more of the money to debt than perhaps we would do. But, you know, given, of course, that our interest bill, etc., that'll be positive to the bottom line anyway. So there'll be a mixture of that as we go forward.
So does that give you a long-term impact in the sense that if you reduce your level of interest payments, that it gives you a bit more flexibility?
Correct. So what we're really trying to do is, is reset the relationship with the banks. Okay, so we've gone through, over the last 3 years, a pretty torrid time, and therefore, trying to get ourselves in a position that the banks are looking out the front window rather than at the rear vision mirror all the time as part of the process that we're trying to go with as well with the banks.
Is there a non-financial element to that? I mean, what you described there is almost a sense of relief and freedom that you wouldn't have had if this decision had have gone, say, the other way.
Yeah, there is. So, and look, I mean, the finance documents are driven very specifically around what banks' credit departments want to live with and all the rest of it, etc. And what we're really trying to do now is with that decision behind us is reset the relationship into a much more positive, looking forward relationship rather than always dwelling in the past.
Also on the financial side, last week you confirmed one of your forestry asset sales. You said it was going to expectations in terms of the price that you would get from the market. Does that give you even further financial wriggle room?
Yeah, it does. So we're expecting a minimum of $45 million will come into our coffers. At the end of the day, we are going through a process where we're selling assets which we actually own, like land in the port in Albany, etc. But we're also, as part of this structure, we're going both to the court and to the growers to be able to sell the timber that sits on that land and assign the leases, etc. So the total transaction price is significantly larger. That's just our element, okay? But that again will be used to pay down debt, okay, and to reset the balance sheet. And of course, having both of them come one day after the other is a positive outcome for the company. And we need to be, quite clear that, our debt burden is higher than we would like it to be. There's too much term debt in there, so what we're trying to do is not only reduce the debt, but get the debt more into seasonal, flexible facilities rather than just pure term debt.
Probably in the broad brush, it's probably the first sunny day you've had in a fairly ordinary run of bad weather. I mean, just some of the things that have hit the company in recent years. The unexpected shift in the Japanese market for wood chips, which led to that forestry decision. The prolonged drought in the rural sector, which just almost decade long in some sectors. The live cattle export controversy that came out of nowhere, and the high Australian dollar. Did you get a feeling at some stage that you were always on the wrong side of the coin toss?
Yeah, look, and I mean, I took this job just 2 weeks after Lehman Brothers failed, and this company had, in the lead up to the GFC, had a lot of debt, and that debt was serviceable and all the rest of it. When the GFC hit us and the cash dried up and you've got $1.4 billion worth of debt, it is just not a nice place to be, and we've been sort of fighting that rearguard action ever since in terms of turning the company around. And there's a whole lot of systemic issues, both at an operational level and at a structural strategic level, that we've had to deal with. And we've been doing that in an environment where the credit markets are just really, really tight. And, you know, we just didn't have the credit worthiness to support that huge level of debt. So she's been an interesting old journey, and you're dead right. You know, there's been a lot of these things that have counted against us, but I think the main thing is the company's still here, and we continue to prosper and start to grow and all those things. So, you know, the future certainly looks a lot better than the past has over the last few years.
Well, the saying always is that it's not how you go into the storm, but how you come out of the storm. What were some of the lessons that you picked up in the process?
Look, I think the issue, I don't think a lot of people really understood, and I don't mean just Elders, I think a lot of companies just had too much debt to be able to service in a market that was, when the market fell away, and markets did fall away really, really steeply, okay? You know, the auto sector globally, you know, global production went from sort of 90 million cars a year to 50 million cars in about three months flat. So it's that serviceability of debt rather than the asset base behind it. I think people need to be very clear about. I don't think our structure and our strategy was well communicated or well executed, and so simplifying the business, and clearly that was a message that I had when I came on board, the need to get out of being an investment driven company into being an owner operator was one of it. But it is around good communication, it's around clear execution and focusing on the execution rather than focusing on the next deal or whatever. Get things done, get them done well, put them to bed, get companies running properly, and then move on to the next task. And often I think people do get themselves that they are just, what's the word, that they're over ambitious as to how many balls they can keep in the air at one time, okay? And businesses aren't that simple. You need to really get people focused on what you're doing today.
Well, speaking of focus, share market investors, particularly South Australians, who I think have had almost a lifelong interest in Elders as reflective of the state itself. The investors haven't come back to Elders yet, have they? There's almost this underlying nervousness that we're seeing around the world, because if you take into account your tax win and your debt reduction and your forestry sales and whatever, you might have expected to have seen that reflected in the share price, but there's no movement there.
Yeah, and look, I think part of that is driven predominantly that the retail shareholder dominates our share registry, other than a small number of corporate and institutional investors. And you need institutional investors to create buying pressure on the share price that will take it north. And I think you're right, people are in a bit of a wait and see mood. I think there's two or three things they're looking for in the business. They're seeing that reduction in debt, which clearly comes by events of last week and more ongoing forestry divestment. They're looking to see a clean exit out of the forestry, okay? They're looking to see the turnaround inside Elders, whether the trading business or the network business, both of those, see that turnaround really happen. They're looking for the diversification in the auto business away from the Australian marketplace, so we've got greater continuity and certainty about production, etc. And I think everybody's sort of looking for those telltale signs, but right now it's clear that we don't have a huge amount of institutional investment support, and that's why you don't see the share price moving as you might have thought it could do with those couple of wins.